My question pertains to the Mid-American Energy segment. On page 64 of our annual report, you provide us with segment data for each business. For the Mid-American Energy segment, when I take earnings before interest and taxes and add back depreciation expense and subtract CapEx, the result is negative operating cash flow. When I repeat that exercise for each of the past 5 years, in its best year, the segment generates $308 million of operating cash flow. When I divide that by tangible assets, the result is a return on tangible assets of 0.86%. Why are we allocating capital to a business that in its best year generates a return on tangible assets of less than 1%?
You were doing great until you got to return on tangible assets. We love the math that you just described, as long as we are going to get returns on the added capital investment. And we are in businesses, whether it's wind energy in Iowa or whether with Pacific Corp after we bought it, there were lots of opportunities for capital investment. NV Energy, which we bought, we're looking forward to putting more capital in, because as long as we get treated fairly by the regulators in the states that we operate, we will get appropriate returns on that. And the return is not measured by the cash minus the increased capital investment we're making. It's measured by the operating earnings after depreciation. And there will be times in our businesses where no net investment may be required, but we actually prefer the ones where net in the utility business where net investment is required, because we like the idea of getting more capital out at reasonable returns. Now, the bet we are making is that regulatory authorities will treat us fairly in the future, and we've got every reason to believe that's true in the jurisdictions in which we operate. And one of the reasons we believe it's true is because we've done so much better than really the great majority of utilities in delivering electricity at lower rates than are charged by most utilities. We have a situation in Iowa, for example, where there is one stockholder-owned competitive utility and some other municipal-owned ones. And if you look at our rates, they are significantly below those of our competitors. In fact, one of our directors has a farm where he buys from two different sources, one being us, and his rate from us is dramatically lower than the one from the cooperative arrangement that exists. So we have a deserved good reputation with the regulators that we're dealing with. We've improved the operations, including safety, incidentally, dramatically from the conditions that existed before we purchased the utilities. That's why they welcome us when we come to new states. And so if we can put more money into useful projects in those states, we've got every reason to believe we will get returns that are appropriate. But if you compute net cash generated from those, you will see nominal or negative figures for a considerable period as we add to our investment and we make those utilities even more useful to people in those jurisdictions. I think we'll get a fair return. we have somewhat similar situation at the railroad too. But we're very happy about both of those businesses. Charlie?
Yeah, if the numbers you recited came from a declining department store, we would just hate it. But when it comes from a growing utility, we like it because we have such confidence that the reinvested money is going to do exceptionally well. It's just that simple.
Yeah. Greg,
Two different kinds of businesses.
Greg, is Greg here? You might be able to give him a few figures that I don't remember off the top of my head in terms of comparative, how our prices compare, and give him a little more of a flavor on how the utility commissions do regard us and how they treat us fairly.
Sure. When you look at our rates across each of the regions, effectively we're generally the low-cost provider or in the low quartile. Your example, Warren, in Iowa is a great example. The last time we had a rate increase there was 1998. We've just currently had one this past year, so it's the first one in the past 16 years, and we don't see another one in the foreseeable future. And when you create that type of model with our regulators, obviously they're very supportive of the various projects we've introduced. So this past year we introduced a project in Iowa. It's a 1,000 megawatt project, $1.9 billion being incurred. And if you go to the gentleman's comment, yes, we're going to put we'll deploy that $1.9 billion over the coming 2 years, but we'll earn an 11.6% return on it. Generally, when we look at our utilities, we do pay attention to our capital. We try to keep it very close to our depreciation. That's what we put back into the business. We'll even earn on that capital. But the reality is the lion's share of our capital right now is growth capital, and we earn a very nice return on that.
Greg, you might comment just a minute. I think they'd find it interesting on what's happening in Iowa with the tech companies simply because of what we're doing in the electric field, or not simply, but in part because of what we're doing in the field of electricity.
Right. So when you look at the tech companies and the data centers that exist, if you just go across the river, we service Google in Council Bluffs. They've got a site that was initially a relatively small data center. They're looking at taking it to 40 to 50 megawatts, which is a small size of a power plant. But the reality is they're talking about ultimately building that to 1,000 megawatts. And we're seeing that replicated time after time in the state. And it's really due to two things. One, we've got these exceptionally low rates. And then the fact that a significant portion of our energy, as Warren highlighted earlier and I touched on, comes from renewable energy. They want those credits. They want to be associated with a utility that's producing green power.